company, and so forth. So these are all of our family companies that work together to deliver the returns that we generate. The people behind that you'll see here on the screen, and you'll see a number of these people in the room tonight. So Jason Battistelli, here to my left, is our COO. I think he went, no, I thought he was wearing the same tie, maybe the same suit. Jason, our COO, started running our property management company, and now oversees our family of companies driving results. Bob Peterson, where is Bob? Bob right there, our CFO. Arguably more important than I am. He's the one who actually makes sure you get paid, and really important, and also a partner in the firm. As is Barry DeGroot, who you'll see up in the top kind of right, who's our general counsel and a partner in the firm. At the middle, sort of the middle of the top, you'll see one of the newest faces in our company that you've never seen before, which is Patrick O'Donnell. Patrick's right here. He is our new Chief Marketing Officer, our first ever Chief Marketing Officer, so welcome, Patrick. Matt John's not here tonight, I don't think. Our controller, he's probably pushing out reports right now. And you see a bunch of other executive leaders, including Jonathan Campbell. Where's Jonathan at? Who runs DLP Realty, and it happens to be his birthday today. I cannot mention John Paul, who's sitting across from him, who's one of our top agents. It's also birthday today. Happy birthday to both of them. And then you'll see Nate, who's actually sitting between the birthday boys. He's the president of Direct Lending Partners and oversees and drives our lending results. Those are some of the leaders who you'll see here in the room. Hopefully get the opportunity to talk to you tonight. A little bit about myself. I've been in real estate for 12 years. I've sold over 7,000 properties. I've acquired over 1,000 properties. I currently own, along with you, 7,500 apartments and about $500 million in total assets. Arguably more important than all that is I have a beautiful wife, Carla, who is somewhere over here. There she is. And two little boys who are 5 and 6 years old, Alex and Donnie, who are with Grandma and Grandpa right now, giving my wife the night off to come join us tonight. And I am the founder and CEO of all the DLP companies, started in 2006. Our purpose is living our dream to create prosperity through innovative real estate solutions. That sounds maybe a little bit big and grand. I'm going to explain and show you a tangible example of that in a moment. These are our 8 core values that truly drive how we behave, how we hire people, the decisions we make, and how we operate. We're a believer that great companies solve problems. So that's really the definition of a great company, is the ability to solve problems. Stories of our start in solving problems over the years in these presentations. I'm going to give you a new example of one today. So that home that you see there is about a $200,000 home. And in 2008, late 2008, I went out to meet with this client who told me they needed to sell that home. And so I met with the client, and he said, I really need to sell my home. Right now I don't have, remember this is 2008, it was kind of a rough time for many people. I don't have enough income right now to support owning this home. I can't keep up with the taxes, I can't keep up with the expenses. He happened to own the home free and clear, about a $200,000 home, but he couldn't afford just the ongoing expenses, so felt he would sell that home, take the cash, and use that to then live off of. He had no good way to earn good, consistent income. So after sitting down with him and understanding the situation and giving him an analysis on the home and what it would sell for, I presented him with the option instead, saying, he ended up telling me his whole financial situation, which would often happen. And to give you an idea, I would do this, going out and meeting with sellers in their homes 2 to 4 times a day for the first entire half of my career. Thousands of homes I've been to Lehigh Valley, sitting down in these similar types of appointments. He realized he had about $150,000 of capital cash sitting. They didn't know what to do with it. It wasn't earning him any income. And so I advised him, instead of selling that home, what if he could earn an 8% fixed return on that $150,000 that would provide him with around $1,000 every month, and then that would cover all of his living expenses for the home. Didn't think that was possible, didn't know how that would happen. Long story short, ended up being one of my very first investors, still with us to this day, who invested that $150,000 or $160,000 with us, allowed him to not need to sell that home, and instead be able to stay owning his home and produce the income he needed to support his life. And that's really how we started with investors. So one of our other investors in the room tonight told me how, and I totally forgot the story,
Now, where is Cindy? Cindy's in the back there. She was telling me just today how I met her. I sold her mom's home, and I asked her when she was walking away with her proceeds at the closing table, what are you going to do with that money? And she said, you know, why? What do you mean? And I offered the opportunity for something very similar, and long story short, that was 6 years ago. She invested that money with us, and was just telling me how much that's impacted her life. And you can talk to her and she can tell you their story herself, but that's really how we started managing money. We didn't set out to be DLP Capital Partners. We didn't set out to have a room of 240 people here tonight. We just set out to solve problems. And in our path of solving problems, we were finding people who, you know, needed income, needed returns when the market didn't provide it, and we started offering that opportunity. So by combining our focus on flipping houses and needing capital to invest, and in turn being able to solve people's problems who needed income, is really what was the birth of DLP Capital Partners. And just one example of the kind of solutions, you know, we focus on solving then and still today. And really how we started and why you are all here is those types of situations. So our track record since then has been that we've hit our fixed and our preferred return targets every single month now for about 10 years since our first investors invested in those fixed notes with us. We've had, again, 0 principal losses and have never missed a return target. In all of our equity funds, we've generated over double-digit returns to investors every year in all of our funds. So in that path of us doing that, we've been growing as a company, we've been growing in our number of investors. One of the things we're most proud of here recently is just this past week, we found out we were one of the Inc. 5000 fastest growing companies in America for the 6th straight year. Thank you. Last year was our 5th straight year, and when we made that list for the 5th straight year, we actually were the 10th fastest growing company in America out of all industries who've ever been on the Inc. 5000 list 5 or more times ever. So it just shows the consistency to our growth, and that same consistency is what translates into the consistency in the returns that we generate to all of you. So that's kind of how we started that story a moment ago, but where we are today is right now we have $550 million in assets. What that means is we own $550 million in real estate and real estate loans. That's over 7,500 apartments. That's over 300 loans. That's across 7 private investment funds and over 500 investors. Again, with 0 losses to any investors, and we have 268 team members making all of this happen. And we're still growing. So often when I tell people those numbers, they say, well, then why are you paying for all of our dinner? And why are we all here still today? Why are you still bringing in capital? We're still growing. So by 2022, we expect we will be $2 billion in assets under management, which is roughly 4 times our current size. So we'll be roughly 4 times our current size in 5 years. That'll be over 10,000 apartments, over 1,000 loans, so our lending side is growing faster than our multifamily side. We'll have by then over 1,000 investors, and we will no longer be doing the events here most likely. We will need a bigger venue. And again, still maintaining our 0 losses, and we expect we'll have over 350 team members by that point. So a little bit about DLP Capital Partners, the investment side. Again, my partners are Bob Peterson and Barry DeGroot. Barry's our general counsel and Bob's our CFO. We are approved through most of the major brokerage custodial platforms like Charles Schwab, so you can invest directly through custodial platforms. We have multiple registered investment advisory firms like Cornerstone in Bethlehem, Young's Advisory in Saucon Valley, who invest their clients' money with us. And also if you need additional kind of guidance above and beyond what you do with us, can provide you great services as well. So we are institutional in quality. Our funds are audited. Third-party audits by Bucknell Lasicki in Allentown, a large regional accounting firm. This is where we operate. So our headquarters is really down the street on 701 West Broad Street in Bethlehem. We've been there about 8 years. That's our overall company headquarters. We have about 110 of our team members who work from that office. We just purchased the headquarters, our Southeast headquarters in St. Augustine, Florida, where I work out of most of the time, as does Barry DeGroot, our general counsel, and some of our other leaders. And then we have 3 additional offices in the Poconos, in Daytona Beach, Florida, and another office in St. Augustine at the beach, which some of you have actually stayed there, as we have some guest suites connected to that office. We have over 500 investors, many of which are invested in multiple of our investment funds. We operate in all of these states you see in green. So these are the states we do business in. You'll notice most of those states on the West Coast have no numbers in them. That simply means we have not yet done business in those states, but we are approved to lend in those states. We're not actively looking to buy in most of those states, but we would lend in those states. And you notice a lot of loans and properties. So the white are the properties we own. The black are the loans we own throughout all those states. So as you can tell, we do a lot of business in the Southeast and a lot here in Pennsylvania and New Jersey. This little map, which I know is going to be impossible to read, but this is in your brochure as well. Every one of those little pins you see is an apartment community that we own. And you'll see a lot of those apartment communities throughout Georgia, South Carolina, North Carolina, Florida, Mississippi, Alabama, and of course here in Pennsylvania as well. So why should you be interested in investing in DLP Capital Partners? Above and beyond the returns, we really focus on providing transparency. If you have not yet logged into DLP Crowd, it's a login that all of our current investors use, which gives you all of your reporting, all of your distribution history, everything you can want to see. But you as a prospective investors, you can actually see all of our historical financials, the actual balance sheets, the income statements, the third-party audits, everything on our funds since they opened, and see all the due diligence you want to see to be comfortable. There's no black box effect. You know what you're investing in and how we operate. The other reason you should be interested is because of these two investment strategies I'm about to talk about. So we have simply, it sounds like we do a lot of things, we have a lot of companies, it's complicated, but there's really only two really things that we do. So I'm going to talk about the first one and then the second one. The first one is we make private loans to real estate investors. So really important there, that's real estate investors, not homeowners. So we do not lend money to homeowners, we lend money to professional real estate investors. A stat just came out this past month that was actually even shocking to me, that the private lending space, the private real estate lending space is now a $62 billion industry. It has skyrocketed over the last few years. There's an enormous need for private lending because of bank regulations, the need for speed in lending, which banks tend to move very slow with all the regulations. We have an aging housing stock, which need homes that need to be renovated, and a very low inventory of homes, which is creating a big opportunity for investors to create new inventory, to renovate old inventory, and so forth. And maybe the simplest way to describe why this industry exists is to ask you the question, have you worked with a bank recently on a loan? If you have, you probably know how difficult that was and how challenging and slow that process was. It tends to be due to federal regulations. It creates a big opportunity for short-term lending like us. We lend to, though, bankable investors. So if you can't read this, it says, I'm sorry, but do you offer anything other than your wife and a cat as collateral? So we do not lend to investors who don't have assets, who can't get a loan from a bank. We lend to, on average, our average borrower has over $1 million net worth, has close to a 700 credit score, has about $200,000 in liquidity, and has completed at least 15 real estate investments. So successful professional investors. We mitigate risk by A, lending to good investors, but also because our average loan to value is just 55%. Our average loan to cost, which is even more important in my eyes, is 73%. Meaning on average, the borrower put 27% of their own money out of their pocket when they bought the property. So usually, actually, they put about 40% of the purchase price out of their pocket. And I believe that's the most important way to mitigate risk. I didn't go through it first time. If anybody's been here for a few dinners expecting me to now ask how many homes foreclosed from the downturn, right? I removed that this time, but because I've asked you guys so many times, too many of you know the answer now. But over 10 million homes foreclosed through the downturn of the real estate market. Less than 10,000 of those homes put 20% down. So if that doesn't tell you something about the importance of borrowers putting cash down, I don't know what does. So we really focus on that if we know if borrowers put significant skin in the game, they don't walk away. And that's why we've had no losses on any of our loans that we've originated, about 1,000 loans to date. We focus on lending on single family and multifamily properties, typically properties that would produce strong income. Not all the houses we lend on get rented, some of them get flipped, but strong income producing properties. Again, strong borrowers. We don't just trust the fact that, all right, we lent to a good borrower, we required them to put cash in it. We also go out and we physically inspect every property we lend on. We get a professional inspector, goes out, walks the property, evaluates the scope of work, evaluates the neighborhood. We get a third-party appraiser to go out and appraise the property. We do our own internal valuation of the property, so we do a lot of due diligence on both the property and on the borrower. These are some examples of the types of properties we have recently lent on. So this is the inside of a house that we just did a loan on a few months ago. So you can see the bathroom was gutted, most of the house was gutted, the kitchen was really dated. And then this is a little detail on the borrower. He had a 756 credit score, a net worth of about 600 grand. He was an experienced flipper. We did a loan for 180 grand on a $305,000 home, 59% loan to value, 14% interest rate. And this is what it looked like at the end. So really good professional borrowers who know what they're doing. So, and then he actually also ended up building 3 houses. He did a subdivision as well. Really great loan. This is another example. This was buying a home that was partially built in a neighborhood of unfinished homes. So he came in. This borrower had completed 15 projects. He was a repeat client of ours. Had a 684 credit score, a $5.8 million net worth. We did a $456,000 loan on a $765,000 home. And this is what it ended up coming out as, fully renovated. There was, I think it was 2 houses on one loan, but completely finished this house, really nice modern finishes, and sold it in less than 6 months. Our average loan pays off in about 8 months. Again, we do not lend to this guy. It says, I heard flipping houses is a great way to make money. So we lend to professional real estate investors. So how do you participate in this strategy? First of all is our lending fund. So lending fund is on since year number 5. I know it's going to be hard to read, but this is in your brochure as well. So I'm just going to give you the quick highlights. You invest in this fund. The goal is to generate an 11% annual return net to you, with a 10% preferred return, which means you earn 10% before we earn anything. We pay out all the profits every single month. And maybe most exciting of all, at least to some investors, and maybe to me in this strategy, is you can redeem your investment with just 90 days notice. So you're going to get double-digit returns with monthly distribution and a high level of liquidity. This is, again, hard to read for you back there, but this is the return every single month since we opened this fund. This light green color is the target of 11. The dark green is how much we generated above that target every month. So you'll notice we exceeded our goal every single month since the fund's been open. On average, we're at 14.5% net return since we opened the fund to investors since 2014. We have a similar fund called the Income and Growth Fund, almost the exact same structure. The only difference really is the Income and Growth Fund will make loans to properties that DLP owns and the lending fund does not. This fund doesn't have as long of a track record. We opened it in 2016, so 2.5 years. We're at 12.33% net return to investors, and actually expect that this fund will generate very consistent, if not a little bit higher returns than the lending fund moving forward, which I can get into later why that is. So 30 plus months of generating 11% net return to investors. And then if you want to invest in an even lower risk profile, this is our lowest risk profile, and again I can explain more in a little bit, you can invest as a fixed note. And how this works is you choose how much you invest, 100 to 250 grand, 250 to $1 million or $1 million plus, based on how much you invest and how long you commit. You can commit for just 90 days, 3 years, or 5 years. You'll get a fixed return. That return is guaranteed by us. It's not guaranteed by the FDIC. It's guaranteed by us. That we sign a contract that we're obligated to pay you this return each and every month. You can take distributions every month, or you can let it compound and grow. Your choice. And you can switch at any time. So you can even do a combination of both. So 6 to 9% based on how long you choose to commit and how much money you choose to invest. You can invest in any of our investment strategies through an IRA. So if you have a self-directed IRA, an old 401k, you can invest via your IRA into any of our different investment strategies. Hold on one second. You guys aren't waiting for me, are you? No. Okay. Just making sure that I wasn't holding them up to bring you your dinner. So our second, and the last thing before I finish this, I'm going to cover the last strategy. It'll take just a few minutes, and I'm going to wrap up. In my opinion, the only reason to not choose this investment strategy is taxes. So if you do not invest via IRA funds, you'll pay ordinary income on the returns. So just like any other income you earn, you're going to pay ordinary income. If you invest through an IRA, it's going to shelter that income for you. So if you have money and you don't want to give Uncle Sam a lot of your money, That's where strategy 2 comes in. So if you don't want to give Uncle Sam a third of your money, so it's not qualified or IRA money, and you want to shelter that money from tax, this is the strategy you should be interested in, which is us buying multifamily apartment communities. So we buy mainly, our main focus is buying 200 to 500 unit apartment communities that are what's called B class, which if you don't know what that means, that's okay, I'm going to explain in a minute, and are typically value add, meaning we have to do some level of improvements, usually renovations to the apartments. So I don't have a spotlight, I'm going to skip over that at the moment. These are some of the example communities that we own. These are actual communities we own. 416 units, Gulfport, Mississippi, 419 units, Columbia, South Carolina, 170 units, Orlando, Florida, etc. So these are the communities we actually own right now. So how do we mitigate risk in this strategy? I told you about on lending, good borrowers, low LTVs, low LTCs, inspecting the properties. How do you mitigate risk on apartment communities? Well, first is strong in-house management. So we do all of our property management other than one portfolio properties, all in-house. So great in-house team of leaders who drive results in these communities. These are some of our leaders here. You'll see a few of them in the room here. We need to get Hank a new picture there. Hank and Carlos are right here. They oversee the on-site capital improvements and development of all of these assets. And I also will pause here because I didn't previously see Larry Greenberg, who's our head of DLP Builders, has also led a lot of these renovations as well, sitting over here with Bob Peterson. And then we have 5 gals who really run the show in lending. So Mary, who's our VP of Property Management Operations, Amy, VP of Leasing, and then 3 phenomenal regional property managers. Actually, we have 3 regional property managers who really drive the results out in the different communities. The next way we mitigate risk is through disciplined buying. So who here knows what a cap rate is? Okay, a few. So a cap rate is if you bought a property for all cash, what would be your return? So example, if I bought a property for $1 million and it was a 5 cap rate, that means I'd earn $50,000 a year, 5% of $1 million, okay? Most of these types of apartment communities we buy are generating a 5 or 6% cap rate. We focus on buying properties at much better prices. In fact, we have to be able to generate an 8.5% cap rate, which means that same $1 million, we have to be able to generate $85,000 in return. That means we have to pay much lower prices and generate much more value in order for us to buy a property, which is one of the many reasons why our returns are so strong. That's not easy to do, as I'm going to show you in a moment. The next way we mitigate risk, the most common question people ask me about risk in real estate is interest rates. Well, when we take out a loan on a property, we're typically locking in our interest rate for 7 to 12 years. So our interest rate is locked in for 7 to 12 years in a non-recourse loan, typically right now in the 4% interest rate, 4 to 5% interest rate range, with agency lenders, Fannie Mae and Freddie Mac. So we're not exposed to interest rates going up. So you might say, well, Don, if you're buying these properties at such great deals, why doesn't everybody just do that? Well, it's very hard. So we analyze 300 to 500 deals every single month. We then go out and really do a full evaluation, go out and walk the properties, dive very deep into the financials, talk to the seller and the broker, and talk to the police station, and pull past financials and analyze all the financials on about 40 to 50 properties every month. About 20 to 30 of those we do full on-site inspections and evaluations on, walking every apartment, walking the competing communities. Then we put out about 15 to 20 offers a month out on the best properties that we think we have a chance at getting our price. Out of those 15 to 20 offers, we win 2 or 3 times. Out of those 2 or 3 that we win, we end up buying after we get through all of our deeper due diligence, where we spend hundreds of hours out at the property. 1 or 2 of them we end up actually buying. And then we go through and fully onboard that property and take over the management and start doing all the work of typically renovating the apartments and so forth. So it's very hard. You have to first have 300 to 500 deals to look at, and then be able to funnel those to analyze down just to be able to buy 1 deal a month is what we average. All that work, hundreds and hundreds, probably over 1,000 hours a month to buy 1 property. But the properties we buy generate very good returns. Again, these are where our properties are located. Often, as I said earlier, we go in there and we add value through renovations. This is what Carlos and Hank's world is all about. So we're going in there and renovating bathrooms and kitchens and ceiling fans and new doors and hard surface flooring and repainting them. So this is actually a property that Larry led a conversion on here in Nazareth, Pennsylvania, to give you a local example. This was, the first floor was a a laundromat, a tattoo parlor, and an Edward Jones, I believe, when we bought it. Odd combination. And then the second and third floor was basically a rooming house. Literally, the tenants had to go across the hall to a shared bathroom with their other neighbors. This is on Belvedere Street in Nazareth. Really bad condition. All the units were in terrible, terrible shape. So we came in there and we redid the entire inside and outside, turned this from 9 apartments to 16 apartments. That's what the outside looks like now. So if you go drive down Belvedere Street in Nazareth, you'll see it's probably the nicest looking building around there. And every inside of every unit looks just like that unit, completely renovated, all new kitchens, all uniform. And we took the average rents from about $400 a month to $825 a month that they were bringing in on this property. That's a small property, but it was a big project. Another example here is, let me get out of their way, is a community that we own. This is called a Cardinal property. We own 9 communities just like this one. These are all single-story apartments. Almost every one of them, Carlos, tell me if I'm wrong, almost every one of them looks like this when they get into that property. It's not really every unit, but it feels like it's every unit. Looks like that. There's mold issues, wallpaper issues. They're in rough shape, a lot of the units when we buy these properties. That's an actual inside of one of the units. That's a pretty typical vacant unit that we come into. We come in here and we clean up the outside, and we come in and put hard surface flooring in, new kitchens, redo the whole unit. Typically, we're driving up rents $150 a month from the units in good condition up to the newly renovated units right after we take over. So that gives you an example. A lot of heavy lifting, millions and millions of dollars of capital improvements we're doing on an annual basis into these properties. So we look at it as added values, what we call it value added investing, which you see there. If you can read that, it says 1 + 1 = 3. Typically, you tell your kids that that's not the correct math, but that is the math, or it says 2 + 2 = 5. That is the correct math in value add. We have to be able to increase the value drastically above and beyond what we're going to invest for it to be worthwhile and to get to the returns we need. So why be interested in multifamily investing? Rentership is on the rise. Who wants to take a guess at what percentage of Americans are homeowners? You can just shout it out. 30? 40? 60? 45? This gentleman here was correct. It's about 60% right now are homeowners. But keep in mind, a decade ago, it was just a hair under 70%. So it's dropped by nearly 10% in the past decade, and most expect that to continue. Homeownership's declining for a lot of reasons, including people are starting their lives, starting their adult life, per se, of marriage and babies, much later in life. So who wants to take a stab? And why don't we ask this couple? What do you think the average age of people get married and have their first kid now? 25? 25? Any other guess here? 28, 29, 35, close, 37. So people usually don't buy their first house until they get married and have a kid. So that's why people are starting their adult lives, the desire to be a homeowner, much later in life. Plus, a lot of people don't even have the desire to be a homeowner anymore. They want the transient ability of not having that commitment as well. I know that surprises a lot of people. So we think rentership is going to keep growing for all of those reasons, which is why we think it's great to own rental properties. We invest specifically in the Southeast because of strong job growth, strong population growth, and strong demand. Who in this room has thought about moving to the South? Here's the reason why we invest in the Southeast. Because most do at some point, and most will continue to do so. People are going to go to warm weather. I don't think that's ever going to change, and I think now people have more flexibility than ever to do that. So in the Southeast, there's strong job growth, population growth, which means there's a lot of demand. We invest in what's called secondary and tertiary markets, which means we're not investing in Atlanta or Miami. We're investing in Warner Robins and Titusville because there's less competition. All the big institutional REITs aren't out there trying to buy in those markets. So we get stronger returns, there's less competition, and by being in lots of smaller markets gives us a lot more stability. I'd rather be in 10 Georgia markets than Miami. No offense to a few of our team members who live down in South Florida, but that's to me a lot of risk to have a lot of money in a market like Miami. I want to be spread into a lot of smaller markets. So why do we invest in B class? So who here knows what a B class apartment is? A few, okay. Most of our existing investors have a good idea, I think. So B class apartment typically is an apartment that was built before 2000. So usually they were built in the 80s and 90s is the kind of average age. So what that means is they don't typically have as modern features inside the unit. They often don't have elevators. They often don't have big clubhouses. They're not as nice as brand new luxury apartments. So you might say, well, why wouldn't you want to own the nicer properties, right? For our personal homes, we'd all like to own the nicer properties, right? Well, let me ask this question. I know existing investors, no cheating here, because I just told you this if you were paying attention during the happy hour. How much do you think rents have gone up in the past 10 years? So you might say, well, why? 30%? 50? 115? So about 50% rents have gone up since 2008. So who thinks income has gone up 50%? Right? So income has not gone up even 10%, but rents have gone up 50%. Anybody see the problem there? So rents aren't going up, or rents are going up dramatically, incomes are not. And so you would think, all right, so since incomes are not going up and rents are growing up so much, you would think that people would be building a lot of affordable apartments then, right? Because people need a place to live. So what percentage of homes built and homes and apartments, housing, that's been built in the last 10 years has been Class B, has not been luxury, high-end, expensive rents? 0. None. Every single apartment community being built is Class A, meaning the rents are, example, in a Jacksonville, Florida, or here in Lehigh Valley, Pennsylvania, $1,500, $1,600, $1,700 a month average rents. When people can't afford that, the jobs don't support it. So our average rent is about $800. Those are the kind of rents people can afford. So we focus on investing in the types of properties that people can afford, especially as rents continue to grow. So we think when a recessionary environment comes, people are going to still have to live somewhere, right? I love the fact that I always hear on media, on big general media, they say, oh, people are going to go back and live with mom and dad. Most people don't go back and live with mom and dad. Some of you might have had that happen to you, I'm sorry. But that's not what most people do. Most people have to live somewhere. So they're going to have to go from that $1,500 a month apartment they can't really afford to that $800 a month apartment. Once they can stop living on their credit cards, which frankly is what most people are doing today. Because the qualification for most Class A apartment communities is 40% of your gross income, what most people rent. Most people have to live somewhere. If 40% of your gross income, which is 60% of your net income, goes to rent, how do you pay your bills? Right? So we focus on this housing stock, which there's no new supply and lots of demand. So how do you invest in this strategy? Through our DLP Preferred Returns Fund, or we call the PREF Fund for short. Each month, it's going to produce around 8% cash flow to you each month, annualized 8% return. I'm sorry, each month or each quarter. So it's a little bit lower return on the upfront than the other funds. Almost all of that income is going to be sheltered from tax. Instead of giving Uncle Sam a third of that income, very little of it is going to go to Uncle Sam as we generate cash flow out to you. And then at the end of the fund, in year 5 or year 6, when we sell off all the properties, our goal is to return back to you 1.5 to 2 times your original investment, bringing your total return up to over 12% annual return net to you, plus some major benefits of the tax savings throughout that investment. If you choose, but this strategy already has a tax shelter through depreciation. So I know what you're thinking. Wow. So if you're interested in taking a step further, we're not here taking any checks tonight, any ACH information, although Bob probably has a form with him. We're not taking any commitments tonight. If you're interested, it's going to be as simple as sitting down with myself, Larry, or Bob for a one-on-one meeting. Or you can also go to DLP Crowd, the website I mentioned earlier, where you can see our actual financials, our actual past performance, our actual audits, and do more due diligence on your own. We love the opportunity to sit down with you and see how what we do could apply to your situation and your goals. So last couple things I'm going to cover here before I turn it over to questions. First is our next events. So if you want to come join us in Florida in September, we'd love to have you down there. Many investors who in this room, raise your hand if you come down to see us in Florida. Come on, you've been down there. There's a few more about over there, yeah. So a number of people, we've had probably about 30 total investors who come down to Florida and joined us. We'll put you up in one of our beautiful We'll be right back here. $1 cash. We'll be right back here. $1 cash. 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 Which is a big system that's very, very expensive that we have a membership to that gives us unbelievable access to data, study, really just about any metric we want to see. So we pay a very large overall fee to have access to that data source, and that's our primary source of data. We have many other kind of other sources of data, every sort of factor in big depths. We can drill down to zip codes, neighborhoods, regions, and study really just about any metric we want to see. So we pay a very large monthly fee to have access to that data source. So and that's our primary at today's date, we are not an RIA, we are not a registered investment advisor, and we get access to information. We will be any day. That's the biggest one. We're only an RIA, not to sell any. We're not being set up to sell any securities, but we have to be because we're too big. Once you get to a certain size, you're forced to become an RIA. Good question. Because we're actually looking to sell any other products. At today's date, we are not an RIA, we are not a registered investment advisor. Selling products and working on your behalf. We will be any day. We're simply selling. We're only an RIA, not to sell. We're not being set up to sell any securities, but we have to be because we're too big. Once you get to a certain size, broker dealers, you're forced to become an RIA. Not because we're actually looking to sell any other products. Basically, it's myself. No, we are not a fiduciary, so we're not out there selling products and working on your behalf. We're simply selling. Larry Hicker now, who's our investor. We do not pay commission on raising capital. We work with all the investors directly. We don't pay broker dealers. And we don't have capital, but we don't pay money for commissions or anything. Basically, it's myself, Mike Kay, who's our director of development, who's somewhere around here. Is there right there? Raising capital. We work with all the investors directly. Bob Shimon, we work with all the investors directly and bringing the capital, but we don't pay commissions or anything out for raising capital. Yes. So first, you can invest through. Charles Schwab is the most common custodian we work with. That you can go and see more information. But if you wanted to talk to an outside group who can give you a deeper perspective on this, yes. So first, you can invest through. Charles Schwab is the most common custodian we work with. That you could go and see more information. But if you wanted to talk to an outside group, wealth manager give you a deeper perspective on us, and they have many of the best clients invested with Cornerstone. They're a $6 billion RIA, heavy due diligence on us. Their Barron's number would be more than happy to give you their perspective. You can talk and they have many of their clients invested with us. Their analysis on us. And they've done heavy due diligence on us. Another great group locally. They'd be more than happy to give you their perspective. You can talk to their investment team. They have many clients give you kind of their analysis on us. It'll be another great. They'd probably be the very best one. Another great group locally is Young's Advisory. They're in Saucon Valley, and they have many clients invested with us as well. It'll be another great group to talk to. As many people have done so. Great question. That's a good question. That's a good question. So I would say really I don't know if weakness is the exact right word, but I'd say I would say really our strength is the same thing as that I'd say. I don't know if weakness is the exact right word, but I'd say our biggest challenge. So I think the same thing as that I'd say is our biggest strength, which is finding great people. Caused our success. So I think it's what we do really well. I think we have tremendous people. I think that's what's caused our success. But as we continue to grow, that is the biggest challenge. That is definitely the hardest part of what we do. That is definitely the hardest part of what we do. The biggest thing that could restrict our growth. And then these guys here have to get the salespeople. And then these guys here have to get the salespeople to sell. So talk to them about that. That's our other challenge. There we go, John.
There's the number, Don. This new venture's $24 million.
When you get to the $2 billion, what kind of percentage is going to be the lending business? What percentage is going to be the real estate?
Good question.
And as time goes by,
our current portfolio is real estate we own versus 20% are loans we own. So we expect the lending side will grow much faster and will be at about a billion. So our lending side is going to grow by about 8 times its current size. Our real estate holdings will grow about 2 times its current size. Yes, the real estate side is a lot more work. It takes a lot more people. We have about 25 people in our lending company and 150 people in property management. But it provides another asset class where you can defer tax, which a lot of people want, and another way for me personally and how I like to invest and have both ways to defer tax and a way to generate good, consistent cash flow today, which is how a lot of our investors look at things as well. Great question, John.
What's the minimum investment?
The question was, what is our minimum investment? So in our fixed notes, the minimum investment, the 6 to 10% fixed notes is $100,000. And before I give the rest of the minimums, they're a minimum in terms of your overall investment with us, meaning the investment can be split amongst multiple investments. So to go into the income and growth fund, it's $250,000. The lending fund and prep fund is $500,000. But that can be split, meaning if say right now you had $200,000 in a fixed note, you could invest 50 grand into the income and growth fund in 2 separate accounts. Same thing as you grow. If you were in a situation where you said, hey, I have 400,000 and I want to go into the prep fund, you know, we can usually make exceptions and work with you, especially as we're looking at a longer term plan. But that's the general guidelines. So the short answer though is 100,000. Any other questions? I got this one.
Where is the focus in the real estate market? Is it more or less in the apartments, or is it in private real estate?
So the question was, where is our focus in real estate? So our focus is pretty much 50-50 between the lending side of our business and the operation or asset acquisition side of our business. And those two sides overlap in a lot of cases too. And then that's as far as the investing strategies. As a whole, you know, we have a man sitting across from you will tell you the number one focus is in us selling real estate as he runs DLP Realty. But that also ties a lot into our investing opportunity because all the single family homes we buy come to us through DLP Realty. And a lot of our investors and clients come to us through DLP Realty as well. So they all tie together, but you know, lending is basically sort of one side of the house and the real estate side is the other side. Good question. Any other questions? And why would, oh, go ahead.
My question has to do with further markets. We all know.
Everybody quiet down just a little bit, please. Thank you. Go ahead, sorry, sir.
We've all seen the typical models of real estate, peaks and valleys, 10-year cycles, etc. We know we're headed into could be a valley. We know that we could be headed to a correction. You know, generally that's regional specific, etc. But we really don't know what's going on. And things are going quite well, and for the foreseeable future they may be doing quite well. But nevertheless, my question is, when that does occur, and your anticipation of that, what sort of preparation or maybe safeguards or building into your investments for your investors they may be anticipating and preparing for now?
Great question. So his question, to reiterate, is when the next market correction comes, which it will come, you know, real estate, like every market, goes through cycles. They go up and they go down. So when the real estate market goes through its next correction, say a 2008 type event again, you know, how are we preparing for that? So that's, he's absolutely correct. We will go through a correction. I think we're about 2 to 2.5 years away from that happening, but that will happen. And I would say the market correction coming is the exact reason we invest the way we do. So on the lending side, it would be much easier for us to make 5-year loans or 7-year loans or 10-year loans than it is to have to write loans that pay off in 8 months. 40% of all of our loans will pay off this quarter. 40%. Meaning we have to do the work of originating those loans and finding those borrowers and mitigating that risk every 8 months. It's much easier, and that's why banks don't like to do that, because it's much easier to make a loan for 20 years or 10 years or 5 years. But the way I look at it is, if we go into a market correction, I don't want to be stuck on a loan on a property while the value is declining. So for us, our loans are only 8 months. Our average loan to value is 55%. The values can't go down 50% in 8 months. Unless the world falls apart, which we have bigger problems probably than how our returns are going to do if that happens, it's not possible. So by us keeping our loans very short in duration, worst case scenario on that side is we can't make new loans. We have to return capital from a practical standpoint if we can't originate because it's a rough market. But then again, ourselves and many others flipped tons of homes and found the most opportunity when the market was really bad. There's the most distress. So we think there'll be lots of active investors and lots of great deals. We might have to lower our loan to value even lower, only lend to the biggest and best borrowers, but there will be opportunity. We won't be stuck that we made a loan for 500 grand and now the value keeps dropping and we get upside down on our loan. On the multifamily side, as I said earlier, we buy affordable apartments. So if the real estate market crashes and unemployment soars, which happen always when a market correction happens, right? And lots of people lose their job and incomes go down, what are people going to do? They're going to have to live somewhere. So we believe the $1,500 a month apartments, the $2,000 a month apartments are going to have vacancy problems as those people flood to our apartments, the $800 a month apartments. So believe it or not, from 2008 to 2013, when property values dropped 30 to 70% across many markets, rent stayed the same on average across the country. In many markets, they went up in the B-class apartment space that we invest in because the demand is so high. So and I could go into a lot more detail there, but those are a couple of the high levels to how we think about it. And our biggest challenge, really, when the market goes through a major correction, is you. It's all of you. And this is our focus right now, is if we can build the confidence with all of you to stay with us and want to keep your money with us as we capitalize on all the opportunities that come in distress, we think it's going to be an amazing time to invest. But if we have investors who get nervous and want to put their money under their mattress, that's where the bigger challenge is for us, is if people don't want to take advantage of the opportunity because they're so afraid. That's why we try to do these events. That's why we give so much communication, so we can build your confidence that actually when the market's crashing, you want to put more of your money with us and take it away from the real high risk opportunities that you might be in today that you're comfortable with the risk in today's environment. So hopefully that's a question. I'm happy to dive into it deeper as well. Any other questions?
I have a question.
All right, Meg.
Sorry, I'm trying to make it go towards the back because But my question for you, at my age,
Should we guess?
Slightly older than you, why should I invest with you?
That's a good question. So,
And what's the risk?
And I'm going to give a hint here that Meg, her father, and her grandfather are invested with us. So the short answer is we've all seen the charts, right? If you're young and you open an IRA and you let it sit and you just put in that $4,000 every year, how much you're going to have. And we all say, man, I wish I would have done that sooner, right? Anybody ever had that feeling? I wish I would have put money away sooner. So when you can invest in a strategy that produces, let's say, an 8% return consistently, and you're younger and you're not looking for income right now, you're just looking for growth, and you have the ability to let that money sit, it is amazing how it'll grow over the course of long periods of time. When I was with Gunther, I was with Gunther at the radio station on Wednesday, I think, and one of the radio spots I recorded was about an investor of ours, Lisa, who put her money in with us 7 years ago and now has earned, it just broke, earning the exactly 200 grand that she originally invested. So now she has 400 grand. 7 years ago, she had 200 grand. She hasn't needed the income, she's working, she's just looking for growth, and she doubled that money in 7 years by not touching it, and she's in our fixed notes. So imagine, and the amazing thing is the rule of 72. So if you take the return you earn, take 72 divided by the return you earn, tells you how long your money takes to double. So if you're earning a 10% return in 7 years, your money doubles. So again, if you had 200 grand, in 7 years you have 400 grand. In 14 years you have 800 grand. In 21 years you have 1.6 million. In 28 years you have 3.2 million, to give you the idea. That's if you're earning consistent returns, which is why that's our rule number 2. If you're in the stock market, you went up 30% one year and down 20% next year, you don't get that same value of compounding returns. So thank you, Meg. Any other questions? All right, everybody wants the raffle. All right, so thank you very much. I'm going to do the raffle here in just a second and let everybody mingle. You have the baskets? Yeah. We have to collect them. Oh. All right, so we're coming around to collect the baskets right now for the raffle. So if you have not yet filled out these little forms here, if you're a prospective investor, fill out the green one. If you're a current investor, fill out the white one. We're going to come around and grab them, and we'll do the raffle in about 2 minutes.